Turkey's central bank has today opted to maintain interest rates, citing positive economic growth and below-target inflation. But amidst the negative attention the region has received of late, how is the economy actually performing? Inan Demir, chief economist at Finansbank in Istanbul, is on the phone with me now. Inan, how does the recent unemployment data bode for the domestic economy and future growth?
Well, looking at the recent unemployment data, what we see is a slight pickup in the unemployment rate in seasonally adjusted terms to 9.4% from 9.2%. But the important point to note about the unemployment data is that the increase in unemployment rate is driven more by an increase in the labor force participation rate rather than an increase in the number of unemployed. In fact, Turkish economy has consistently been increasing the total number of employed, and the increase in labor force participation ratio, which itself is an indicator of hopefulness regarding future employment prospects, is the factor that drives the unemployment rate higher. So, despite the seemingly negative headline regarding the unemployment rate, I would take the labor market conditions in a more positive light. The big unknown, of course, unemployment rate is a lagging indicator, and it does not reflect the effects of the recent escalation in the domestic political tension, and it remains to be seen whether that tension will have a bearing on the GDP growth and consequently on the unemployment rate. Perhaps Turkish Central Bank is also opting to wait and see what will happen to GDP growth in light of the recent escalation of political risk in Turkey.
You mentioned that social tension, yet despite this, market volatility has been relatively muted. Why is this? Is it due to perhaps the central bank possessing a broader remit than its other EM peers?
We could say that, of course. The central bank has been very active in the FX market, particularly recently, so that sort of toned down the effects of the unrest on financial markets. We saw last week on Tuesday central bank stepping in to curb Turkish lira weakness by selling FX and also cutting back on the liquidity that it provides to the market. This is Turkish lira liquidity I'm talking about, so that interbank rates will increase towards 6%, the ceiling of Turkish Central Bank's interest rate corridor. The aim, of course, is to provide FX liquidity to the market on the one hand, and also providing carry to support Turkish lira. These measures seem to have stabilized lira, but still Turkish lira remains vulnerable to shifts in global risk appetite, and it will be very important to see and hear the messages from Fed and the Fed Chairman Bernanke tomorrow to get a grasp of how Turkish lira will behave in the coming days and weeks.
Nonetheless, there has been some weakness across Turkey's currency, bonds and stocks in the wake of ongoing protests. Where has this pressure been felt most acutely, and how long-term do you consider this impact?
Well, given the central bank's intervening tendency in the FX market, the pressure in Turkish financial markets were felt most acutely in the stock market, partly driven by the fact that Turkish stock market has performed so well over the past year or so, also inducing equity investors taking profits from those long positions. But regarding the long-term effects, I mean, the acute phase of the sell-off is probably over in the stock market, but then one has to remember the fact that the statements from Turkish government and Prime Minister Erdogan himself have not been particularly market-friendly recently. The Prime Minister has been accusing the so-called interest rate lobby as behind the recent protests, and he was also calling on his supporters to use state banks instead of private banks. And these are, of course, increasing risks regarding the competitive landscape, particularly that the banking sector, the private banks are facing right now. And concerns about these could dampen equity flows going forward as well. So, as I said, even though the acute phase of the sell-off in the stock market is over, there could be concerns about the governance and competitive landscape in Turkey going forward, and that could have a negative effect on equity inflows.
We've touched upon central bank intervention, which saw the Turkish central bank sell $250 million to banks at 5 intraday auctions in a bid to stabilise the lira's value. The central bank has stated that it is prepared to act again. Do we see these auctions becoming a regular item on the central bank's agenda?
That will depend to a large extent on the messages that we are going to receive from Fed tomorrow. If we see messages that would stoke investor concerns regarding a tapering off of Fed's asset purchases, then the Turkish Central Bank might need to resort to FX selling once again. Of course, there will be other tools on the table too. The central bank could reduce the reserve option coefficients and the reserve requirement ratios on FX liabilities so that it could provide FX liquidity for the market. But FX selling is another direct measure to target lira weakness. Also, one could plausibly think about central bank hiking the ceiling of the interest rate corridor so as to offer a higher carry for Turkish lira. But given the government's strong attack on the interest rate lobby, I think the room for maneuver for the central bank will be limited on that count. And that leaves the possibility of higher reliance on FX sales to moderate Turkish lira volatility.
Inan, thank you very much for your comments. That's all from me, but click back to Dukascopy TV for more exclusive interviews. Goodbye for now.